Good evening, everyone. Thanks for joining us on our monthly webinar. We have a very interesting topic today on de-dollarization, which is a term which has been used, I would say, in various contexts quite liberally. We have tried to share our views through our monthly newsletter in this month's newsletter. And I'll get my colleagues Manish and Trilok to talk more about it shortly. So as usual, we'll start with our performance of all our schemes on PMS platform. We have 4 products and Manish will take you through the performance of our products and then take you through our theme for the month, which is de-dollarization. And then Trilok will follow it up with some more trends on macro, which we are observing, as well as a unique opportunity which is presenting itself to equity investors at this point of time, which has been quite unique in terms of some, I would say, very unusual phenomena which we have been seeing over the last 15-20 years. But I'll get Trilok to talk more about it when it happens. So Manish, over to you. Kindly start.
Thank you so much, Sushant. Now, the theme for the month is de-dollarization, and we'll come back to that. But just a few seconds on the performance of each of the funds. Now, Coffee Can for the month was up about 5%. A very strong comeback in this current calendar year, CY23, where the markets have now started rebounding, right? April saw that, May so far has seen that. And the good part is that your portfolio is kind of rebounding very, very strongly along with the same trend. And that's something very heartening to know. But more importantly is the fact that when you look at the top performers below, which is Eicher Motors, ITC, and Nestle, right, which are up about 11.8%, 10.98%, and 10.4%. These are some of the recent changes that we had made, and so glad to see that these changes are now kind of starting to show effect. These are starting to contribute as far as the overall return profile for the portfolio is concerned. And this basically means that the portfolio has not only stabilized, which was the period of January and February, but when you look at March, April, and so far what has been happening in May, what you realize is that the portfolio has started outperforming, started showing performance in a very, very strong fashion. Amongst the bigger detractors is LTIMindtree, which is not very surprising given what is happening to the IT sector overall. But the good part is that the stock continues to remain above our buying price, and if and when it continues to correct, we are expecting a slightly weaker Q1 result season. We still have about a couple of percentage points of position to be built up over here, and we'll continue to buy that. And amongst the other 2 stocks are Relaxo and Axis Bank, both marginally down to flattish in this current month. And Axis is something that we are still in the process of building up a position. So as and when the stock continues to either remain sideways or correct, we will continue to buy this stock out. But the good point again is to, when you look at the consistency that Coffee Can showed between 2017 right up till 2021, what you got to understand is 2022 was more of an aberration. It was not the trend. It is not, of sign of things to come through. When you look at CY23 so far, not only are we in line with the market, but when you look at the 3-month performance, we are about 2 percentage points ahead of the market with a very strong 4 percentage points return profile so far. When you move on to the next one, which is Ambit Good and Clean Portfolio, what you realize over here is that in the last 1 month, we have delivered about 4 percentage points return, which is largely in line with the market. We are up about 1% in the last 3 months, which is again in line with the market. And if you look at so far in the calendar year CY23, we are down only about 2%, almost flattish, which is largely in line with the market performance. And with this, the track record of Ambit Good and Clean continues to remain intact. When you look at it from the perspective of the last 5 or 6 years, we delivered a very strong 16% odd return in CY16. We were up about 5 percentage points as compared to the broader index in CY18. We delivered double-digit returns for the next 3 years, which is CY19, 20, and 21. And then we have been largely flattish for the last 1 year, which is CY22, when the markets were in a big turmoil. And now we are poised to take off, and the return in itself is starting to show. So again, another one of Ambit's funds which has delivered very strong results in this month. But more than that, the fact remains that some of these stocks where we continue to hold on to our belief, which is Chola, which is AU, which is La Opala, have been showing results. All of them have very strong double-digit returns so far. And that's where the heartening news is coming in. And again, 3-month performance well above our target rate. When you look at the next one, which is Ambit Emerging Giants portfolio, again, largely in line with the market, about 4 percentage points up in the last 1 month, 4 percentage points up in the last 3 months, and again, about 2 percentage points ahead of the market over a 3-month period. But again, significant to note that 1 year, 2 year, 3 year, 4 year, and 5 year across all time frames. This is one portfolio that is consistently outperforming the market and remains a testimony of our capabilities, of Ambit Asset Management's capabilities to not only pick quality stocks, but to pick correct stocks and to hold them from a long-term perspective to yield that result. When you look at the bad times we had in CY18 and CY19, right, and the way the portfolio kind of protected the money at that point of time versus CY 2021, when the portfolio delivered a compounded return of close to 44-45%. And then now, in the last couple of years, when the market has been choppy, this is a portfolio which is again marginally in the positive, again giving you very, very strong and solid returns. The last one which I wanted to touch upon is Ambit TenX, which has delivered again 5% returns for the last 1 month, 3% returns for the last 2 months, and again 5% returns for the last 3 months. This calendar year so far, we are up about 3% as compared to the broader market, which is down 1%. In a very short span of 15 months, the portfolio is up about 2%, which has been a phenomenal feat given the volatility in the market and the ability of this portfolio to kind of protect the money even in these torrid times. The top performing stocks over here are Safari, Chola, and AU. And the worst performing stocks over here were Awas, LTI Mindtree, and Garware, which was marginally in the positive. So in conclusion, as far as performance is concerned, what I would want to point out is that your portfolios, all 4 of them, have witnessed quite a significant amount of change in the last 5 to 6 months. We have changed around weights, we have changed the sectors, we have taken some very strong and very bold calls. And very happy to see that these calls are playing out. The performance is not there in just 1 or 2 portfolios, but it is very broad-based across all the 4 portfolios. And this is a testimony of quality investing, which is basically the ability of the portfolio to not just hold on to the returns, not only protect the money in tougher times, but to rebound in good times when the bull market comes. And that's why we always tell people that equity investing is all about investing A, in quality, and B, over a long period of time, which is 3 to 5 years, where your money multiplies. Every market is going to go through phases. Every market is going to go through cycles, and every portfolio will also have periods of outperformances, underperformances, strong performances, weak performances. But the fact of the matter is, if you're a patient investor and if you pick the right kind of portfolio which invests in quality stocks, over a block of 3 to 5 years, you're bound to make money because quality always pays, right? And that's what we in Ambit Asset Management believe in. Now, moving on to the topic of the day, which is basically de-dollarization. Now, first off the bat, what is it that we mean by de-dollarization? Now, you must have noticed that ever since we all have been here, we've only talked about dollar as being the global reserve currency, right? Every bilateral trade that happens between 2 countries happens in dollar terms, whether the US is involved or not, right? So now India could be importing crude from the Middle East, from Saudi Arabia, but usually the trade used to happen in dollar terms, right? So it was an all-important currency, and that showed also the global dominance of US. Now what we are going through, you must have heard the news intermittently ever since the lockdown came through because of COVID-19. What you must have noticed is that each country is now trying to settle trades in their own local currency. We have China, which has been selling the US Treasury bills. We have Japan, which has kind of paired the position over there as well. We have countries like India who are importing crude directly from Russia and making the payment in INR terms. And we have countries like China who are trying to import and settle, the trades in their own local currency. And in essence, what is happening is dollar as the primary currency, right, which was being used all over the world for oil, for trading, for commodities, right, everything, for keeping forex reserves, everything. I think more and more countries in the world are starting to look beyond the dollar. These are early signs, but they are starting to become visible. And that's essentially what we mean by de-dollarization. Now, if you look at the last, few years, probably since 1500, the 15th century or thereabouts, what you'll notice is that whichever country dominates the global trade, whichever country dominates the global power, is the one that usually is a global reserve currency, is the country that usually dominates the entire trade cycle of the world, right? So it started with Portugal, and for about 80 odd years, then Spain came into the picture, then Netherlands came into the picture, then it moved to France, United Kingdom, and since 1920s to 1930s to now, it has been the era of dollar. What you'll notice in the time frame, the commonality that exists over there is the fact that every 80 to 120 years, the global reserve currency kind of takes a very dramatic change. The position of power globally moves ahead with somebody else, and the hands kind of change over there, right? And that's essentially what is known as a change of stance, the change of power position globally. And that's, I think, what is the starting point where we are today, which is basically de-dollarization, right? Now, what leads to de-dollarization? What are the certain signs that we've seen for de-dollarization? If you move to the next chart, what you'll notice again is that number one is that both China and Japan, which are some of the biggest holders of US Treasury bills, right, which in effect also allows US government to fund its own budget deficit, right, by selling these Treasury bills in the international markets. These are the two countries that are the biggest buyers of that. Over the last few years, last couple of years, have been paring their position down as far as the US Treasury bills is concerned. They've been selling them in the market. Number one. Number two, in the last 30 odd years, if you notice 40 odd years, the share of global trade has moved, and it has moved very dramatically. While in 1990, US used to account for almost close to 11-12% of the overall global trade. Today, US accounts for a very minuscule 8% or thereabouts, but the share of China, which used to be just about 1.8% or thereabouts, is now closer to 14-15%. And that's the start of the cycle, right, where the global dominance as far as international trade is concerned is moving away from the developed countries like Europe and US, and is more moving towards emerging markets like India and China. And that's where the start of the de-dollarization phase is now starting to happen. What are the signs that we are again seeing from an international trade perspective when you look at the last few odd years? Number one is that US imposed sanctions on Russia, right? Now, this was a very interesting viewpoint where when the Russia-Ukraine war situation started, most people thought that this is going to be the end of the Russian economy, and the US-Ukraine-Russia war is not going to last very long because of the SWIFT sanctions. Russia is not going to be able to sell crude in the international markets. But lo and behold, China and India came forward. They were ready to buy the Russian oil at a discount and ready to settle the trade in local currency, right? Bilateral trade moved to local currencies, and we kind of figured out an alternative to SWIFT, right? And these are some of these early signs that if India can be the largest purchaser, and if India's volume of purchase of Russian crude can move beyond the volume that we have been purchasing, for example, from some of the Middle Eastern countries like Iran, etc., and then this is a sign that India's mindset is now there. We have kind of decided on this factor, and we are going to move ahead with this. We are already in talks with a certain number of Middle Eastern countries to now start settling the crude oil trade in INR terms with them as well. And more importantly, the 5 emerging markets, right, which is the BRICS country, Brazil, Russia, India, China, and South Africa, have been talking about coming up with a possibility of a union, possibility of a BRICS currency, which is going to be then used as the global currency to settle trades into. by these 5 emerging markets, and that can eventually emerge as a second euro and eventually an alternative to the dollar that is now coming through. So de-dollarization is here to stay. De-dollarization is a trend that is going to pick up pace over the course of next 5 years, 10 years, 20 years. But when you move to the next slide, what you'll realize is that one thing that you have to agree on and you have to contend with is the fact that it is going to be a very slow and a very gradual process. Now, for all the fear of de-dollarization and a lot of people wanting to figure out what the impact of de-dollarization and incrementally countries like India, which are moving away from dollar into rupee trade, what does it mean for them and how long before we start seeing the impact of it? The answer is very, very sure shot, and the answer, the writing on the wall is very clear that it is going to take a few decades. Not a few years, not a few months, but it's going to take a few decades. It's going to be a very slow and a very, very gradual process. That's point number one, right? Number two is that not only trade, but geopolitics is also going to dominate in this area. China could have very easily emerged as a very, very viable alternative to US. But the fact is, where they score on trade is where they lose out as far as geopolitics is concerned, right? And that's where I think this process is getting slowed down. Had China played the geopolitical card very, very smartly, I think they would have come up the ranks much swifter, and yuan probably would have been an alternative to dollar in a matter of a few years rather than a few decades. But a place where China continues to score ahead is the global share of trade. And despite all the supply chain disruptions that we have happened in the last 3 years, despite all the lockdowns that we have had, and despite all the geopolitical tension that we have had, China continues to dominate this space and continues to expand its footprint. And all the talk about localization by countries like India and US have actually not yielded too much result on the ground yet so far, right? And that's where I think the situation is. Now, what does it mean for India? I think one is that it gives India a better geopolitical power from a global perspective. It gives us some teeth. We have seen this. Now, earlier, if 20 years back, somebody would have told you that India is going to be buying crude from Russia at a time when US is imposing sanctions on it and Russia is in a war, a bilateral war with its neighbor, it would have been unthinkable. But because we have started to move away from dollar, because we have started to realize US as more of a trade partner than anything else, rather than an ally, I think this again means that from a global stand perspective, it gives us a little more teeth. It gives our foreign policy a little more teeth. Second is we get better access to funds, right? The Indian government gets better access to funds and corporates also. And thus it plays a very, very vital role in strengthening the local currency. It stabilizes the currency. And that's, again, a remarkable job last year that RBI had done in terms of managing not only our forex reserves, but also the currency in the way that they managed. Rupee could have very easily gone to 95 or thereabouts, but I think they handled the situation very, very swiftly. And second is that it becomes a country for a multipolar world. We start doing bilateral trades in INR, and which kind of not only helps control the current account deficit to a very large extent, not only enables us to manage the balance of payment to a very large extent, not only helps us manage the currency volatility to a very large extent, but also has a positive impact on inflation, right? Where we saw last year, we were getting a very significant amount of Russian crude at a very significant discount. Otherwise, the situation could have very well gone out of hand, and the CPI inflation and the WPI inflation could have been far worse than what it was. So the benefits are definitely there, but they are more incremental in nature. They are not path breaking. And it is going to be a slow process, which is going to change over a period of time, and looks like sitting where we are today, India and China together emerge as the next alternative superpowers to Russia, to US, which is dominating the scene currently. So that's essentially what we had to talk about as far as de-dollarization is concerned. What I would do is invite my very, very good friend Trilok to take us through the macroeconomic trends in the country and what is his view and how he is looking at the markets right now, and why, like Sushant said, it's one of the optimal times to look at the markets and why a very mouth-watering opportunity awaits you. Trilok, over to you.
Yeah, thanks Manish for taking us through for a decade change. And good evening, everybody. So I would like to take you through a couple of important things which is happening in the country, and also I'll take you from a perspective of how things pan out when the interest rate cycle changes. Now, to begin with, if you look at the manufacturing PMI, which is obviously, so India has always been one of the service-oriented economy, thanks to our the way we have built the nation over the last several years. The brighter side, I would put this way, India manufacturing PMI is actually one of the probably highest in the last 5 to 6 years. In fact, in the global context, most markets, are witnessing moderation or a contraction in terms of manufacturing index. However, India is a bright spot in the overall context, and if in fact the recent reading took it to even further from what earlier we had thought of. So, both manufacturing as well as services continues to do exceedingly well for the country, and India stands out completely compared to emerging markets. Moving to the next point, the biggest concerns over the last 12 to 18 months in markets have been how the inflation will pan out and what's the sort of outlook for the inflation has been, because from being a inflation being transitory to acceptance of inflation being a little sticky, that whole cycle has played out in a matter of 15 months, which obviously had led to substantial rate hikes by all global central bankers as well as emerging market central bankers. In the in this backdrop, obviously, interest rate has taken a meaningful hit thanks to inflation and the monetary policy adopted by global central banks post COVID when it was in 2021. Now, the good news is that is history. Inflationary trends globally is obviously seeing a substantial easing, led by commodity prices easing globally. Also, food prices have come off, and importantly, the freight cost, which had gone up nearly 7 to 9x post-COVID due to supply chain disruption, are actually below pre-COVID levels. In fact, as we speak, in the month of April, we have seen a global freight rate index below March 20 level, which is a very, very, I would say, positive sign from an inflationary perspective. But obviously, there are some signs of macroeconomic slowdown globally, and which is why this kind of indication is also happening. But we are very, very confident that India will come out with flying colors, similar to what happened in the last couple of global slowdown, because India is a more domestic consumption oriented economy. Now, as you can see, there is a very, very, so over the next 12 months in particular, we expect a meaningful, contraction in the inflationary trend, and which will obviously lead to the reversal of interest rate cycle, which has been a big pain point over the last 18 months. Coming to the fact that inflation, coming to the next point, when the interest rate, so this is a very, very interesting perspective. If you look at the last cycle in the last decade, usually interest rate is a big, element for equity or any riskier asset classes to deliver return. In fact, every 25 basis point change in interest rate has led to a similar sort of 20 odd base, similar sort of impact on the equity asset classes. In fact, emerging market as a basket, which you can see on screen, is the most impacted from an interest rate cycle, both from a local as well as US rates perspective. And there is a significant inversely correlation between the two. Now, in our understanding, thanks to meaningful inflationary trend in favor of central bankers adopting to a much I would say softer stance going forward, you would see a meaningful change in the way investors think about cost of capital and essentially asset classes like equities. So this has always been the historical cycle, and there is no reason to believe it will not repeat in the future. Although that the the overall quantum or the magnitude could be very different. However, we strongly believe that you will see a meaningful opportunity of interest rate cycle coming down and equities as an asset class moving up. and that's been the history, and that's been the reference point that we are referring to. This is again, followed up by the very strong, and this flows, if you look at both domestically and in from a global perspective. In fact, the SIP flows, as we all know, right, has kept market, I would say, in check despite global sell-off. In fact, to the extent of CY22 as well as CY23 till date, we have seen nearly $19.5 billion sell-off in the economy by the FIIs. However, that is obviously been completely sort of contract completely been taken care by domestic flows, and domestic flows has particularly been very active by SIP flows. Now, our sense is when the interest rate will start reversing sooner, than later, and obviously equity as a class, significantly benefits. India completely will stand out in context of FIIs also returning to the country, because if you look at all other countries on the chart, on the slide visible to you, all in other economies in emerging markets, Indonesia, Korea, Russia, China, Brazil, Taiwan, these are all having its fair share of issues, both domestically in terms of growth rate, as well as their the external funding and borrowing is extremely under difficult situation, unlike India, where it's completely, I would say, not isolated, but significantly, much better position compared to global peers. And to top it all, when you look at the valuations where we are, markets is, I would say, in a very sweet spot. It's still trading below long-term averages of 20p from 1 year forward perspective. In fact, importantly, our return, which is the balance sheet and the return on equity, this is significantly better than the last cycle. In fact, now expected we are already at a multi-year high return on equity. In fact, we will probably in FY24 the corporates will deliver best ever ROE in the last 15 years. Similarly, the mid-cap ratios is in line with long-term average, completely not reflecting the strong momentum in the earnings growth cycle. And importantly, despite the fact that India stands out in terms of economy, in terms of growth rate, in terms of external factors as well as domestic factors, our multiples is nowhere significantly higher compared to the past. In fact, our average India, we are trading at similar to long-term averages from India as a market, and also in context of long-term averages, we are marginal premium to MSCI emerging markets. So that's the perspective we wanted to share. With that, I would like to hand over the session back for a Q&A, and we'll be more than happy to answer all the queries that you may have.